Did Jerome Powell give the green light to further dollar weakness in what he said last night?
He did nothing to make you buy it. I think it's probably the right way. But I think up to a point, though, what did we expect him to say other than what he did say? I think that's the first question. So there's quite a lot in the price. My concerns about the dollar and the amount it's gone down and recently probably center around the fact that August is illiquid, volatile, nasty and dangerous for markets and has been for a long time. And that's not bad for the dollar. And the market has now got a pretty solid bearish consensus sitting here. So if the dollar's still here in September, I'll take Jay Powell at his word and I'll be selling it again with enthusiasm. Right now, I think I'm likely to want to sit back and beware volatility that supports it.
Kit Juckes, we usually talk to you about foreign exchange. I want to rip up the script here today and really shift over to the fixed income space. We can do that. Thank you, Irving Fisher. Kit Juckes, it's real simple. The bond market is speaking in volumes. There is an assumption that the United Kingdom can avoid negative rates. There's certainly an assumption that the United States can avoid negative rates, and the market is testing that right now, isn't it?
For sure. Look, the trouble with negative rates is that they're in nobody's plan. And as Mr. Tyson said, everybody has a plan until they're punched in the face. And this pandemic is punching policymakers firmly in the face. You can't rule it out. I think the UK would be wise to do everything they can to avoid negative rates, given the size of the current account deficit, the position of the currency at the moment here. So would avoid it for different reasons from the United States. But we may yet have to find something that we can do. So it becomes a question of diminishing choices. And no one's going to take negative rates completely off the table.
Well, but what I find interesting here, Kit, is the idea of a Europe that instituted negative rates before the market caught up. That's just one theory, one idea, versus the market directing central bankers towards policy. Is the market going to tell them that you have to avoid negative rates? I mean, are we days or weeks away from negative rates in the United States? It really tests the central bank as an institution.
We're not quite there yet, but it's when nothing else works, you get pushed. Look, the people who went to negative rates first were ones with big current account surpluses, a lot of excess savings, who were doing it in part to force money out of their currency and weaken it in Japan and Europe. And that was one of the means of easing monetary policy further. So it's a dangerous policy in the UK, which needs to attract foreign capital. In the United States, you could easily have negative rates from the perspective of if it would weaken the dollar, I'm not sure policymakers would complain. The problem in the States is a more mundane one, that they want to resist it because the money market funds are so important, and it would damage the plumbing of the financial system. And we've already seen since March how vital it is that we keep the plumbing of the US financial system or the dollar system working properly. But I come back to it. If we got God forbid, but if we got a nasty second wave globally that really sort of started impacting economic growth in September, October, but central banks are going to be looking and fiddling around in what's left in their toolbox and seeing what they can do.